Good morning, everybody, and welcome to our August monthly IFRS webinar. Good morning, Kevin.
Good morning, Aletta. It's good to see you all up and about again in Melbourne. And good morning to all our attendees. It's good to have you again.
Yes, it's wonderful to have you all. I think we've seen an increase in our attendee numbers, and I said to Kevin, it's because people are at home in lockdown, and we have to provide some light entertainment, Kevin. So I hope you have a few war stories and jokes for the session today.
Absolutely.
So our August
I had to
session.
get the shirt out, including that I had to get this out and iron it just so that I could actually look presentable to everybody today.
It is so funny now that we all work from home, when I know the camera is going to be on, you have to pay a little bit of attention. Usually I go for a walk in the morning and then I just start working in my exercise gear. But I did have a bath this morning and put on a beautiful top, similar to your beautiful shirt. So we're all ready.
Already.
Okay.
Let's jump in share-based payments.
So in our August webinar, we thought we'll talk about the ins and outs of share-based payments. Now, this webinar is not meant to make you an expert on IFRS 2. What we're trying to say is flag, or it's a bit of a risk assessment, a risk awareness campaign around some of the things we are seeing around share-based payments. So as a result of COVID-19, we are seeing a lot of share-based payments. We are seeing a lot of modifications to share-based payments. We're seeing cancellations, etc. And those are complicated stuff. So we thought it might be a good idea to just step back and say, listen, let's put IFRS 2 back on the table. Let's look out for IFRS 2 and let's consider when are we changing these and, how does it impact our financial statements. So all about risk awareness today. So the outline of our webinar, step back and say, why do we have IFRS 2? And I think that is important because it gives you the big picture view on when to look out for potential IFRS 2 if you understand why we have it in the first place. Then we look at some defined terms, not all of them, and we look at the scope. And scope on IFRS 2 is critical because once you're within the scope of IFRS 2, substance over form can't get you out. And we've had a number of examples recently where you in the scope of IFRS 2 and people try all kinds of fancy ways to get out. It's not easy to get out. So scope is actually really important. And people want to get out of IFRS 2 because they don't want a fair value or they think it's difficult to fair value. And that's not an excuse in accounting. It's difficult to fair value, but we have to come up with our best attempt. So we then move on and we talk about recognition. And then we split into the equity settled share-based payments with particular rules and examples. We look at cash settled share-based payments, and we also touch on share-based payment transactions within a group of entities. And I've put there in red at the bottom the big thing I want you to think about and look out as you finalize your 30 June 2021 reports and as you have your audit committee meetings is to think about modifications which would include cancellations and settlements. So that's just a bit of an overview of our session today. So why do we have IFRS 2 in the first place? Now, when I started studying or started my career years ago, in the old days, the good old days before 2005, and I used 2005 because AASB2 was issued in Australia in 2005 or became applicable in 2005. I wish I only started my career then, but unfortunately I started a long time before that. But in the old days, if an entity paid for goods or for services with share options. Now, no journal entry was processed. So the best example of that, and I think the one that most people can associate with, is if we paid for the services of our employees or our directors by giving them share options, no journal was processed. Now, why is that significant? if we don't process a journal in respect of these share options, it meant that in our financial statements, we did not book an expense associated with these share options. So it would look as if our directors and employees are working for the organization just for the cash consideration they receive. In actual fact, we might be paying them a lot more because we're giving them share options or shares that are indeed very valuable and over time become more valuable. So I think it was two reasons. We didn't give it, the problems are twofold. One, we didn't get a fair reflection of what these directors and key management personnel really earned. And I think stakeholders want to know that. And the other thing is our P&L of an organization did not fairly reflect performance. So after we've issued IFRS 2 in Australia, a basic journal that would have been processed for these share options would have been you debit an employee expenditure, salary and wages, which is not just cash, and you credit, for example, a share option reserve. So now you can see that employee expenditure is in the P&L, and if the employee expenditure related to key management personnel, it would show up in a remuneration report, and we know stakeholders are really interested in that. So it also links with related party disclosures in IAS 24. So big picture, we want to make sure that when organizations receive goods or when organizations receive services and they're not paying in cash, but they're paying through the issue of equity items like shares or share options, or even if they pay cash, but the amount of cash you're going to pay is linked to the value of your shares, then you're within IFRS 2. All right. And once you're in, it's like a jail, very hard to get out, hopefully impossible to get out. So let's look at an example just to put a bit of numbers around it. So if company A remunerated directors and senior staff and there's cash of 500,000 and 2 million options, and the fair value at grant date is $1 per option, it would look as if these directors and senior staff own only 500,000 because before we've issued IFRS 2, its salaries and wages 500,000, cash 500,000. So, you can't see the impact on P&L, you can't see the remuneration. After IFRS 2, we will have the cash journal, but we'll also have a journal for this share-based payment. And I think that, you can see there it is a big difference. Now, you might say, Aletta, your 2 million is ridiculous. And I think in practice, we've seen it's not ridiculous. A lot of organizations pay consultants, not via cash, but through share options. Potentially, we see it a lot in mining, junior explorers, startup entities. So it's a thing. And we can talk about significant amounts in that space. So that's why do we have the standard. Now, the structure of IFRS 2, I always like a helicopter view before we start. The standard is structured by starting, what is the scope of the standard? When do you have to apply the standard? That's the hardest part. Then it says, so when do you have to recognize these expenses or equity or liabilities, etc.? So recognition, debits and credits, paragraphs 7 to 9. And then the biggest part of the standard is actually about measurement. So if you've got an equity settled share-based payment transaction, how do you measure it? If you've got a cash-based share-based payment, how do you measure it? And if you've got a share-based payment transaction when there are alternative cash alternatives available, how do you measure it? And then obviously each of those measurement alternatives have different disclosures because not only do we disclose the recognition, but we have to disclose the subtleties and the estimates and the judgments around the measurement. So are you in the scope? When do we recognize? And then it's all about measurement. And at the end of it, disclosures, which is often linked to measurement again. So that's the big picture. Now, one of our staff here at IFRS, and she's actually based in Sydney, came up with an IFRS 2 thought process because, sometimes you just don't know where to start and there's so many variables. And Christine said, I think similar to the big picture, but maybe just a slightly different way to think about it. Step one, you would think, is it a share-based payment? Is it within the standard? Is it within the scope? Then step two, how is this share-based payment going to be settled? And then you look at, so what are the vesting conditions? Do we have market vesting conditions that affect the price? Or do we have non-market vesting conditions that affect the number of share-based payments? Because there's two things here. Your measurement is the number multiplied with the price, Q multiplied with P. So market vesting conditions affect price and non-market vesting conditions affect the number, the Q. Then there's something called non-vesting conditions that you have to think about. And then you think about changes in estimates around these non-market vesting conditions. Now, I've included here because I've seen her use it, and I think it's a really nice way to focus your thinking. Because often people get confused by, is it a market or non-market? And if it's market, so what does it mean? What does it impact? Should I consider it? So I think a nice logical thought process to work through. So I will give a shout out to Christine Webb in our team in Sydney for putting that together. Now, before we start, there are some defined terms that I would like to flag. They are covered in the appendix, and there are more ones. I don't want to look at all the terms. I want to look at a few, and in particular, the ones that relate to scope. Now, in this, let's start with a share-based payment arrangement. So a share-based payment arrangement is an agreement between the entity. Forget about the brackets first. It's an agreement between the entity and another party that entitles this other party to receive cash or other assets, but the amount of that cash or the other asset is determined, the blue bit, based on the price or the value of the equity instruments of the entity. Or that other party is getting equity instruments, so shares, share options of the entity. So if you take out the noise in the definition, so the stuff in brackets, etc., you would say it's an agreement between the entity, us, and another party. And based on that agreement, that other party could either receive cash or another asset, and the value of the cash, the amount of that cash, is linked to the price of our shares, our equity, or they actually don't get cash linked to equity, they get the equity straight out, so our equity. And then the last thing I've put there in red, they only get the cash or these equity instruments provided they meet these specified vesting conditions. And vesting conditions could be market, non-market, etc. It's interesting. I think it's important to go step back first, and take the noise out, and then you can add back the noise and ask, why do we have the bits in brackets? It's an agreement between the entity or another group entity or any shareholder of any group entity. So we're not just looking at our entity. This is like an anti-avoidance thing we see in tax, right? It's our entity, it's shareholders in our group, it's other entities in the group. It's basically saying everybody associated with our entity, right? If any of us have an agreement with another party, and that other party will receive certain things, when they meet vesting conditions, we are in the scope of the standard. We've got a share-based payment arrangement. So you can see this is broad, really, really broad. I want to highlight something. And I think, Kevin, did you want to add something? Okay,
yeah, a couple of things, but you go. You finish. No, I was going to jump in with some examples, but finish your thought first,
Okay.
Aletta.
No, that's fine. If you go on to a share-based payment transaction, which is a slightly different um, definition, but it links back to an arrangement, it says it's now a transaction where the entity receives goods or services in red from a supplier or whoever is providing those goods or services. It can even be employees who provide services. And they provide these goods and services as part of a share-based payment arrangement, which means they get paid in a certain way. They get paid through equity, or they get paid through cash that's linked to equity. So we receive goods or services, and we're going to pay them in a certain way. Or we incur an obligation to settle this transaction with a supplier in a share-based payment arrangement when another entity in our group receives these goods or services. Now, this is important. You'll see I've put in red, receive goods or services, or another group entity receive goods or services. The absolute first way into IFRS 2 is you receive goods or services. And those goods or services could be clearly identified, specified, or there could be, and this is where it gets really nasty, there could be a transaction where they don't specify what are the goods and services that we receive. But you have to think, why on earth will we be issuing shares? Will we be issuing equity? Will we be paying out amounts if we're not receiving a good or a service? And that's when we talk about unidentified goods or services that you have to look out for. Um, so the whole thing is step one. Do we receive goods or services? Do another entity in the group receive goods or services? Think carefully. Second step, and we are paying them through equity, or we're paying through them through cash or assets where the amount is linked to our own equity. I think this is the crux of the standard. Kevin, I'll pause there to catch a breath, and you can add some examples if you wish.
No, absolutely, and thank you, Aletta. I mean, it's a good discussion to be had, because going back to basics on this with defined terms. Our listeners today will wonder why we're spending so much time here, but actually, I think we've all become so smart. We think we know what these standards are actually saying, and more we're getting into transactions where, going back to the definitions, you really have to work through the warren of reds and blues that Aletta's pointing out. And one of the ones that I keep getting stuck on, because it keeps coming up, is especially when we're issuing shares, let's say convertible notes, and we've engaged financial service providers to assist, which they may be doing legal agreements for us, or issue costs or agent fees or whatever it might be. And there's this real tension between which standard are you in, because you're actually issuing a financial instrument which may not be a share-based payment, but you're engaging somebody to help you issue those equity instruments or loans or convertible notes, and they appear to be providing a financial service and a good or a service. So you start to have this tension: which standard are you in? And you've got to work through these. And then even when you're in one or the other standard, sometimes the debit of the financial instrument standard, of the share-based payment, goes back to the financial instrument accounting standard to be measured or accounted for as a transaction cost. So even in just basic equity or financial instrument type arrangements where you're issuing loans or convertible notes, or just issuing equity to the market, there can be a tension with the standard, even just for the services provided by, shall we call them, consultants or lawyers, and there can be this play between them. And that one in particular, I'd like to point out to you, because the primary goal might be the issue of an equity instrument or shares to the market, or a loan or a convertible note, but the transaction costs around it might have this interplay with this standard, and even that can have material consequences if you don't get it right, because you end up measuring or recognizing it under the wrong standard if you're not clear on what it is you're dealing with on those, shall we call them, service elements of the arrangement.
Thank you very much, Kevin. Now, later on, as I said, share-based payment transactions really have three subcategories. We're going to look at equity settled. There's also cash settled, which Kevin will look at later. And finally, there's share-based payment where they're cash alternatives, which we're not looking at today. Already too many slides. But when we look at equity settled share-based payments, so it's this payment transaction in which the entity receives goods or services in consideration for its own equity instruments. So it could be shares, it could be share options, or it receives goods or services but has no obligation to settle the transaction with the supplier. And then cash settled share-based payment transaction, a share-based payment transaction in which the entity acquires goods or services by incurring a liability to transfer cash or other assets, and the amounts are based on the price or the value of these equity instruments. So important to know, at the end of this transaction, are we going to issue equity? Or at the end of this transaction, are we going to give the other party cash or some other asset that is linked to the value of our equity? And that is the distinction here. So if we talk about scope, we've had a few definitions. IFRS 2 applies to all share-based payment transactions. So all three categories, as we talked about earlier. It also includes share-based payment transactions where shares are transferred by shareholders to parties, including employees that have supplied goods and services. So it's really important. If it's not in relation to the supply of goods and services, it's not a share-based payment transaction. So as soon as you're in the standard, the only way you can get yourself out is I'm making a share-based payment, I'm issuing shares, but it's for another reason. It's not linked to a good or a service that I'm receiving or another entity in the group is receiving. So this could be a situation where these other parties are potentially acting in their capacity as shareholders. That is, we'll look at that, I think, in the next slide. So what we're saying here, what about shares issued by the parent for goods and services received by another entity in the group? Would that be in the scope of IFRS 2? And the answer is clear. We're not looking at a particular entity. We're looking at the whole group. So we capture the whole group. It is within the scope of IFRS 2 as long as it relates to parties that have supplied goods and services to the entity. So if there's that supply of goods or services, you're in. All right, any entity in the group. So what we thought we'll do is do a little diagram. We have a parent with two subsidiaries, and each of these subsidiaries have their own employees. On the left-hand side, we said, what if the parent issues shares to the employees of subsidiary 1? Would that be within the scope? Absolutely. Because the employees would receive these shares because they've provided services to subsidiary 1. So it doesn't matter who in the group issues the shares or the equity to them. The fact is they've provided a service to an entity in the group. We're in IFRS 2. On the right-hand side, we've said, what if subsidiary 2 issues share options for shares in the parent to their employees for shares for services rendered? So, we're going to give you shares for the services you've rendered to us. It's not shares in me, it's shares in my parent. Can that get you out of the scope of IFRS 2? And again, the answer is no. So this is looking at a situation where we're looking at a group perspective. You cannot get out of IFRS 2 by coming up with fancy structuring within the group. That's really what it's saying. It's anti-avoidance.
And I would like to just add there, Aletta, sorry,
Yeah.
is often when you try and get out of the standard, you just make it worse. And I would just like to say that especially when you have multinational organizations where you've got foreign currency differences, it actually just compounds the problem. So just please be careful of your purpose when you're putting those group structures. There's nothing wrong with putting a group structure arrangement together that is honestly trying to compensate the employee, but when you're trying to put it together to avoid an accounting outcome, you're just actually going to make the situation worse. And that's just an important point there. It was designed to avoid it's an anti-avoidance provision. It was actually purposefully thought through right at the start. So just to be aware of that.
And Kevin, it actually is a really good reminder, triggered my mind. Our biggest frustration around IFRS 2 is that people put fancy transactions and arrangements together, and they work very closely with their tax friends or consultants or partners to work out the tax consequences for both the entity and the employee. And they also potentially work with some of people who advise them on the best remuneration structures. I know at BDO we've got people in that space. What is a good way to structure packages for employees, to encourage employees to do the right thing, to grow shareholder value, etc. So entities speak to people on how do we structure it. They speak to lawyers. They speak to tax consultants. But IFRS 2 and the accounting implications, are nowhere to be seen at that stage. And then at the end of the year, when the finance team need to deal with this, and when the auditors start to ask questions, they arrive at our doorstep, and then often they don't like the accounting outcome. So I really want to say that this is something that you have to consider while you put the transaction or the share-based payment together. And I think, Kevin and I have often spoken to our tax partners, our people advisory partners, and say, get us involved when you put this together.
Yeah.
And we have done a few of those, but it's really important.
And let's see if you don't mind me just kind of giving you an example. It was a great example of a recent company. It's a listed company, and they did everything in their power to essentially manage both tax consequences for the company, but also for the employees. So different employees, especially at the management level, have very different needs. And one of the new things well, it's not new, but I've started to see it happening is if the management is actually taking the award in their own in their own self-managed super fund, there are rules about how that happens, and one of the rules is that you've essentially got to pay for the award in cash. You can't fund it in the self-managed super fund through credit. And so there's this new trend where, in order for the management or the employee to get the award in their self-managed super fund, there's essentially a payment for the award at fair value, which later on gets refunded under certain scenarios from the company. That's great. I love the fact that you're looking after your employees and allowing them to essentially manage these awards, according to their own needs. The problem is, every single time you amend something, even if it's for one employee to manage his own personal affairs, it has consequences for the company. There's nothing wrong with that. It's just that you need to be aware it has consequences for the company. And so that means, in that particular cases, and the example I'm using, I think there were two management who got the award in their self-managed super fund, and everybody else got the award in their personal capacity. Those two had to be accounted for differently, because they had different consequences, and it ended up that there were 9 valuations that had to be done, because there were 9 employees and they all had different terms. So each one of them had a different accounting implication, and ended up having 9 valuations. And the company was horrified, because by trying to do the right thing by their employees, all they ended up doing was incurring costs at the company level to account for it. So please just be aware that there are consequences. Nothing wrong with it, but go into this with your eyes open, knowing what the company is going to have to do down the track.
Yeah, and Kevin, later on when we talk about modifications, last year during COVID and still this year, we're seeing a lot of companies, and good on these companies, trying to do the right thing. We're changing vesting conditions to make sure that although maybe share prices are down or profitability is down, their employees are still entitled to share-based payments, but it has consequences, accounting consequences. So it's just, let's think about that before the auditors arrive. And when you make that changes, let's think about it. So I've got a list of a few things we've seen a bit later as well. Still on scope, you know, sometimes when we give shares to employees, they get that in their capacity as equity holders. They already have shares, they get more shares. It's not because they've provided services. This is because they're an equity holder. So that would be outside IFRS 2 because, you know, we haven't received goods and services for that particular issue. So that is something to be to think about. Now, I thought I'll conclude the discussion on scope with things to think about, and I want to call it lessons learned, horror stories. Kevin will recognize a lot of these. Number one, do circumstances indicate that the reporting entity receives unidentifiable goods or services? Because if it's true, then you're in the scope of IFRS 2. So you have to ask yourself, if you're giving away all this equity, what are you getting in return? Because commercially, nobody will give away equity for nothing. All right. So it could be that there are unidentified goods or services, and therefore you're in the scope. Um, that's a big problem. So I've put it first. I've said number two, once you're in the scope of IFRS 2, please don't come and tell me substance over form. I'm going to get out of IFRS 2. You know, and as you know, on previous webinars, I would have told you I'm a substance over form lady, right? I believe in substance over form. But when you get to IFRS 2 and we look at the scope of IFRS 2, substance over form, not interested, it doesn't work. It's not how we apply this particular standard. So it pains me to say it, but substance over form is not getting you out. And then the third one is there are possible scope exclusions. So once you're in, does the counterparty act in its capacity as a shareholder, even though they're also an employee or also doing consulting services? Then that part could be out. Does the transaction maybe meet the definition of a business combination? Because again, then we out, we apply AASB 3. And the last one, Kevin alluded to earlier when he said, are the goods or services acquired in a contract that is accounted for as a financial instrument? Because then we apply IFRS 9. So there is potential overlap here between IFRS 2, IFRS 3, IFRS 9. So be careful and consider that very carefully, and that's where it gets really tricky. So we've spent a lot of time on scope because I believe that scope is the biggest issue here. Once people realize they have to apply IFRS 2, we can work through the consequences. So when you look at recognition, your recognition criteria are basically if you receive your goods and your service, and you issue equity instruments, or there's a payment that's linked to a share price, and that payment could be cash or another asset, you meet the recognition criteria really. The principles would be you recognize your goods or your services in this share-based payment transaction. When? So this is about the date, the timing. If you obtain the goods, or when the services are received. All right, so once I receive the good, that's the timing, or as the services are provided, that's the timing. Then some people would argue, what if we receive a good, but this good does not meet the recognition criteria of an asset? Now, quite often, it's because it doesn't meet the recognition criteria of an intangible asset, to be honest. So I've got the share-based payment transaction. I think I'm receiving a good, but when we apply IAS 38, it doesn't meet the definition of an intangible asset. What now? Then you have to expense it. All right. So it's a research cost that you expense. That's an example. So it's not always I receive a good, now I can capitalize it. That's a different set of rules. If you receive a good, that's the timing that you recognize your share-based payment. But whether it actually is an asset or an expense, it's up to the other accounting standards to still assess that. Services, I would assume, are usually easier because often services are anyway expensed as we go. So share-based payments relating to services, if these share-based payments vest immediately, the services are assumed to have been received in the past, and we recognize it in full at grant date. Now, what does vest mean? I've put the definition up there. So vest means you become entitled to this share-based payment immediately. It's no longer conditional on the satisfaction of anything else. So if you enter into a share-based payment arrangement and immediately you have your share option or your shares, it vests immediately. The one thing we then assume is the services have been provided in the past. You don't have to do anything in future. And therefore, you would recognize those services immediately at that date. Now, that's not often the one we see. The one we usually see is there's delayed vesting because you're trying to encourage employees to stay. You're trying to encourage employees to focus on a particular aspect. So usually the second bullet point, we have delayed vesting. So services are assumed to be received during the period between grant date and vesting date. So we're now going to spread the expense because we are saying, Kevin, if you stay at BDO for the next 3 years, and if you increase our profitability to a certain level, your share options will vest, for example. So we spread the expense over that period because the services will be provided over that period. So it's really a question when you look at services, do you receive this share-based payment for what you've done in the past? Because then we expense it immediately. Or do you receive the share-based payment because we want to encourage you to do certain things in the future, and then we'll expense it over that future period? So if it's equity settled at a very high level, you'll have an asset or an expense, and your credit side will be equity or an option reserve, which is other comprehensive income. If it's settled in cash, again, you'll have an asset or an expense on the debit side, and you credit a liability. And the measurement of that liability is obviously linked to this equity. I've said there for both of them, you debit an asset or an expense, and whether you debit an asset or an expense is determined by other accounting standards, not by IFRS 2, as we discussed earlier. So let's move on and look at equity settled share-based payments. So equity settled share-based payment, this part of the presentation, I've divided into, we're going to look at measurement, we're going to look at vesting conditions, we're going to look at after vesting date and modifications. Now, as you can see, we already, we've got 20 minutes left, so I cannot explore this comprehensively. I might also say at this stage that we have presented a virtual workshop a number of weeks ago, not that long ago. We've recorded that virtual workshop, and you can go on our website, look at virtual workshops, and you can now purchase that virtual workshop. It's a 2-hour workshop. It also had accompanying activities and an activity book where we walk through that in more detail, and it's for the giveaway price of $150. So you can still access that. So I'm just going to put out a few things there for you to think about because Kevin and I realize it's only 20 minutes. So on measurement, measurement of equity share-based payments, we look at the fair value of the goods and the services you've received. So that's the starting point. What are the goods and the services of what I've received? However, sometimes you cannot estimate the fair value of the goods or services that you're going to receive reliably. And by the way, you can never reliably estimate the fair value of services provided by employees. So if you receive these services by employees or you cannot estimate the fair value of the goods or the services, they're saying, okay, we'll give you another way to try and come up with fair value, and that is to look at the fair value of the equity instruments that you've granted. So let's first start with goods or services. If not possible, let's look at the equity instruments you've granted. So remember, and I've put a note there, that this is the date the goods or services are received and not necessarily the grant date, except for employee transactions. So what is the grant date? The date that the entity and the other party agree. Important there that there's a shared understanding. Um, and it's important that you often outline what are the specified vesting conditions that have to be met. And if this agreement is subject to an approval process, then grant date is the date when that approval is obtained. So some key things to think about: have we and our employees, for example, agreed? Do we have a shared understanding? Do everybody know what the vesting conditions are, clearly articulated? But hang on, if this is subject to shareholder approval, then we don't have a shared understanding yet, because the entity might have to back away because the shareholders don't approve. And Kevin, a few years ago, we thought often this approval process is kind of a tick the box exercise. What we have seen over the last 2 years, especially since COVID, is often the approval process, you cannot assume it's going to happen, especially if it relates to the approval of share-based payments to key management personnel. And shareholders might have a say about that. So I think we have to be very careful about, when is it agree? Is there an approval required? Wait until we have the approval. And that
And let's
grant date,
sorry, yeah,
yes.
I'll just, and that's also, it's becoming really interesting because let's just talk in grant date and measurement, but that doesn't necessarily mean that you're not going to have an expense if it's already, if the employee is working towards it. So that's something else I've started to see, and maybe it's something I'm going to get to later, but this concept of making these things close to year end and then having shareholder approvals either just before year end or just after year end, hoping you're going to achieve a certain outcome in terms of when the debits and credits happen, isn't necessarily the same thing. Grant date and approval date for the measurement is one thing, but if they're already working for the instrument before that date, you may actually have debits and credits already flowing through your accounts, which actually makes more complexity. So just something to think about.
Thank you very much, Kevin. So then, a very simple example, if we acquire a building and we know the fair value of the building is 500,000, the journal is simple here. We would say debit a building, we know the fair value is 500,000, and therefore the share capital that we've issued is 500,000. So if the good or the service that you obtain, you can measure it reliably. And remember, you can never reliably measure employee services. It's an easy journal. It gets more harder when we cannot reliably measure that good or the service. So, for example, employee services. So, what would our journal be now? We know we've got a salary expense. We have to measure these share options, and that is where we have to come up with a fair value of these equity instruments at grant date for measurement purposes. And that really brings us to measurement. Now, this is where we talk about measurement is your Q, your quantity, times your price. So your number of equity instruments and the price of those equity instruments in its most simplest form. So your number of equity instruments, if we talk about that first, it is a best estimate of the number of equity instruments that's expected to vest. And you would revise that estimate for subsequent additional information. And on vesting date, you will actually revise it to the actual number that's vested. All right, so the number of equity instruments is a best estimate on day one, and you change the estimate every reporting date, and you finalize the number of equity instruments on vesting date. So when you've done everything and you're now unconditionally entitled to this equity. However, if you look at price, price is either market price, which obviously if you list it, you have a market price, or you have to use a valuation technique to come up with price. Or if your market price is not available, so you're not listed, etc. Now, this is where it becomes an absolute nightmare. Now, from an IFRS perspective, we can give you some pointers, some things to think about. But as soon as we get to this, we would hand you over to corporate finance. We will hand you over to Stephen Sia in Melbourne or David McCourt in Sydney and say, you guys come up with the fair value of these equity instruments. I cannot find a price easily. So again, these are some pointers we've put together. You have to incorporate all factors and assumptions. You should consider the treatment of different options. So, these are high-level rules of thumbs that we've seen working with these valuation experts over time. So European options can only be exercised at expiry date. We've got American options can be exercised at any time until expiry. All else being equal, so that's a big assumption, American options are usually more valuable than European options because you can exercise it at any time until expiry. American options are usually not exercised early, with the following exceptions: it's deeply in the money, or it's before its ex-dividend rate. A few other things, the types of valuation models that could be used. So European options, often entities would use Black-Scholes option model, and you can get corporate finance to assist with that. Or maybe you've got the expertise to do that. With American options, it could be a binomial option model or Black-Scholes with a bit of an adjustment. And if you look at those binomial option models, they are more accurate if they've got longer dated options. Or you've got options on shares where we've got dividend payments. So these are just some of the things to think about. By no means are Kevin and I valuation experts, but just some of the things we've seen when we work with these guys. So the types of valuation models that you use, the inputs we're looking at are share price, dividend yield, your exercise price, your maturity or expiry date, a risk-free interest rate. They look at a volatility, so those are the kind of inputs that we're trying to put in. And if you look at the valuation impacts for some of the movements in the variables, rules of thumb again, if there's an increase in the share price, usually it increases your value of your option. If there's an increase in volatility, it increases the value of the option. An increase in expiry date, it increases the value of the option. If there's an increase in the exercise price, it would decrease the value of the option. So a few things to think about, what the valuers would ask for and what they would put into whatever valuation model they believe is most appropriate for your options.
My 2 cents worth, Aletta, on valuations is everybody seems to think Black-Scholes is the valuation of every possible option, and I'm not really sure where that comes from. It's possibly the way the standard was written, or maybe it was in a simpler time. Black-Scholes was the winner of all valuation outcomes, but as these things have increased in complexity, so has the inappropriateness of that as the only model. Please, before you jump into a Black-Scholes and just hand that over, consider whether it's the most appropriate one. It's not always true, and I think that's what Aletta is trying to get to with Americans and European options. There is that those are basic options, and Monte Carlo simulations and all those things can easily come into it if you're not careful.
Absolutely, thank you, Kevin. The other thing to think about, so we talked about measurement. The other thing is around vesting conditions, and this is an extract from the standard. It's really important to realize that we have non-vesting conditions and we have vesting conditions. So your threshold question is, does the condition determine whether the entity receives the services that entitle the counterparty to the share-based payment? Does the condition determine whether the entity receives the services that entitle the counterparty to this payment? And if you say no, it's a non-vesting condition. And if you say yes, then we would ask, does the condition require only a specified period of service to be completed, because that would be a service condition? Or, is there something else? So it's a service condition plus a performance condition. So just a way to think about, is it non-vesting or vesting? And when we get to vesting, is it a service condition or is it a performance condition? So if you look at the definition of vesting conditions, these conditions must be satisfied for the counterparty to become entitled to receive their cash or their other assets or their equity under a share-based payment arrangement. And, it could be service conditions. It could require the other party to provide this period of service of 3 years. It could be performance, and the performance conditions could actually link to external market information, or it's non-market information. So it could just be a profit over time, or it could be a change in the market price over time. So there's again a subset within performance conditions. Your basic principle about these vesting conditions is your expense is recognized over the period from grant date to vesting date. So, your vesting date would be influenced by whether it's a service condition or a performance condition. And performance conditions could be market or non-market. So that's really what I've got there. If you look at performance conditions, as I said earlier, there are market conditions, external factors, or non-market conditions, internal factors. So your market conditions is where you look at you target an intrinsic value of an option, or you target a share price. It's an external factor. An internal factor, you target an increase in sales, or you target an increase in growth, you target growth in profit, internal measures. It's not available. It's an internal factor as opposed to an external factor, which is a market condition. Really important. So why is this important? If you've got a market condition, so let's say it's linked to growth in a market price or achieving a certain market price, you take conditions into account when you establish your fair value at your measurement date. And you charge your expense even if the market conditions are not met. There's no reversal. So, you consider these market conditions, they impact fair value. And once you've locked in fair value, whether, this is actually achieved or not, you'll have to expense it. There's no revision of the number of instruments that's expected to vest, and your fair value is not changed between grant date and vesting date. So in a big way around market conditions, at measurement date, you lock in your expense or the amount of that expense. Where if you look at non-market conditions, so that's internal factors, sales, etc., you ignore that when you determine the fair value at measurement date. If the condition is not met, whatever you've previously charged is reversed, and your number of instruments that's expected to vest is revised. So your non-market conditions, I would say, is more fluid in that situation. So in the next few slides, I try and articulate it maybe in a slightly different fashion. So when you look at market conditions, so you'll see in the heading, I've put vesting conditions, market conditions. I try and articulate it in a slightly different fashion. And on the next slide, I look at non-market conditions, and there's a lot of nots and no's there. It does not impact fair value. If these conditions are not met, instruments do not vest, no expense is booked. It impacts the number of instruments included, etc. So non-market conditions obviously are internal factors, as we've discussed. So I want to get to two examples to illustrate market conditions and non-market conditions at a high level, appreciating there's a lot of ins and outs here, that we can't look at today. So in this example, we've got 1,000 options granted to vest in 3 years if a target share price is achieved. We've used Black-Scholes. Fair value is $10 per option. There's an 80% probability that we'll reach that target share price. And if the target share price does not reach $15, ever, and let's say the target share price does not reach the $15 ever during the 3-year vesting period, what expense would be recognized in relation to these options? So we've given them options trying to get to this target share price. We've determined fair value, but we never get to the target share price. What now? So in that situation, we would have said you would have worked out your total expense to be the $8,000 for the 3-year period. So it's 1,000 options, the fair value, and you multiply the probability, and you came up with 8,000, and you will expense that 8,000 over the 3 years. So because there's a 3-year vesting period. And even though we never meet that target share price, we cannot reverse this expense. It stays in our P&L. So that is the significance of attaching a market condition to a share-based payment. All right, so that's number one. If you look at the next example, we have 1,000 options, but this time we attach it to a non-market condition. Again, the fair value is $10 to keep it simple, and the sales growth over the 3 years is as follows. And we've said that it will vest if the target sales increase by 50% cumulatively over the 3-year period. Again, we don't get there. So what expense is recognized in this situation? And remember, now we've got a non-market condition. In this situation, upfront, we've worked out, it's 1,000 options multiplied with a fair value of $10. We don't apply a probability at that stage. It never, based on that 10,000, in year 1, we've expensed a third. In year 2, we've expensed a third. In year 3, we realized we didn't get there. It's a non-market condition, so we reversed the whole lot. So you can see we have volatility in this situation. You don't go back and reverse it in year 1 and year 2. You actually reverse it in the current year in year 3. So you can see there's a big difference between having a market condition and a non-market condition on your P&L. The actual amount that's going to go through retained earnings over time, but also the volatility in your P&L. So those are 2 simple examples. In our virtual workshop, we look at this more broadly. Now, this diagram is something I've put together just as a bit of an overview. Service conditions and non-market performance conditions, how do they play into our debits and credits as opposed to market performance conditions. So market performance conditions, there's no change in accounting if the conditions are not satisfied. If it's a service condition or non-market condition, forfeiture accounting if they are not satisfied, with the previously accumulated expense reversed in P&L. All right, so that's a huge difference. So I think this is a powerful slide. On the equity settled share-based payments, we talk about after vesting day, how do we make adjustments if there's forfeitures, etc. There's a slide on that. I want to get to this. And these are examples of modifications that we're currently seeing. We are seeing cancellations and maybe we see forfeitures of awards with the service conditions due to redundancies. We see market vesting conditions being revised because, when the condition, we revise the estimate on when a condition will be achieved during a vesting period to continue to assist employees to actually meet it. We see that maybe we now only have a service condition and these other conditions are removed. We get a replacement award accounting for certain modifications. Modification of market conditions, maybe the target share price is reduced, and maybe we add a non-market condition. Maybe an employee's been stood down for a 6-month period. What do we do now? How does that impact a service condition? What if a non-market vesting condition is not met? Just a lot of scenarios that we've seen over the last 18 months. And we've got a lot of examples on how to deal with those. But I just want to put it out there from a risk assessment perspective. Do you have any of these? There are complex accounting consequences. Um, and at the same time, Kevin, I know we have to talk about cash settled share-based payments a bit briefly, but modifications, I wanted to just flag some things to think about. If we've got settlements or cancellations, when do we have it? What are the accounting consequences? If we've got replacement grants, when do we have it? What are accounting consequences? There are some nasty accounting consequences here. If there are changes to terms and conditions, favorable to employees, unfavorable to employees, different accounting consequences. What are they? Are you aware of them? I know it's a bit rushed. There's no way we can do justice to all of those other than say problems, exclamation mark. Please speak to us. Kevin, do you want to touch on cash settled share-based payments?
Yeah, I will, Aletta. Thank you very much. And I'm glad you touched on the modifications just before jumping in there. I just want to reiterate that with a letter is a modification to you, or as let's say the director or management of the company, may not be what a modification is in the standard. Similarly, what you think is a cancellation might not be a cancellation. So I think that the easiest takeaway from what Aletta was talking about is, if you are using words like modification and cancellation and forfeiture, but you don't know that you're not trying to use the terms as they are meant in the standard. In other words, you're using those terms because you're actually trying to modify or cancel an existing scheme. That doesn't equal the same term in IFRS 2 necessarily, and that's where a lot of the problems can kick up. So there's something to bear aware of. Cash settled share-based payments. I've got to say, we don't often see these, but I often wonder if we just don't miss them, because the default seems to be debit, expense, credit, equity for equity settled payments, and that is a lot of what the equity settled schemes look like, where you're taking a credit to equity. But a cash settled award is one, as the definition says, where you acquire the goods or services and you incur liability to transfer cash or other assets to the supplier, in terms of the amounts that are based on the price for the entity's equity shares. Unpacking that, it's really, you're in the standard, you've got goods and services, it's a share-based payment transaction, but it's really going to be settled either in cash or not by actually issuing the equity per se. That's going to give you a liability, and that's the real crux of a cash settled share-based payment. The credit goes to liability as opposed to going to equity. This is probably the best slide to take away on this, because with the credit going to a liability, you've got a fair value going to a liability, and you have a remeasurement of that liability at each reporting date and at the settlement date, with those changes going through profit and loss. So taking Aletta's equity settled transactions that she's been dealing with, it's not only about vesting conditions and truing up for the number of options that are going to vest or have to be paid out. There's actually another side to this, which is the credit side of the entry in liability, and that has a remeasurement at each reporting date that is required, which is unlike equity settled, where you don't do anything to the credit entry that went to equity. That's not the case with cash settled. But I think the way I'm going to do this is actually say to you is, cash settled are not only cash settled because you call them that. They are also cash settled very often if you're an unlisted company or you've got a share that's trading in an illiquid market. What generally happens there is, whether it's in the agreement or not, the company is going to pay the employee out in cash at the end, because giving them shares they can't sell or trade in is worthless if they've got the share and they can't sell it because it's unlisted, or because it's an illiquid market and they can't really trade in it. So be careful of implied cash settled arrangements. This is where you structure it and it looks like an equity settled arrangement, but really the only outcome is you're going to pay them cash at the end. And so that's actually I call that a lurking cash settled transaction, because it's structured from an equity point of view, but actually really the only thing that's ever going to happen is you're going to pay the cash out. Those are sleeper issues, and they often come back to bite you, especially when you pay the cash out and you've been treating it as an equity settled arrangement all along, but then you pay the cash out and suddenly the regulator says to you, if you're a listed company, but hang on, if you're paying cash out, why wasn't this a cash settled transaction all along? Where's the liability been on your balance sheet for the last X number of years? Now we've got an example here, example 6, and I'm not going to deal with that at all. It's a takeaway example. It's a lovely example. Aletta's put example 7, which Aletta has put together. It talks about number of shares and truing up numbers and got fair value in it. It's a great, go and work through it yourself, and the answer is in there. I'll leave that one to you to work through. Just like I said, be careful of these lurker ones that are out there and you know, should have been cash settled and you might have accounted for them as equity settled. Aletta, if you don't mind, I'll just go straight into this because I think you wanted me to talk about group entities, and we're getting this one a lot as well. Share-based payments among group entities. Now, Aletta touched on it earlier in the definitions about when there's subsidiaries and so forth involved. But the big issue with group entities is you've got the financial statements of not necessarily the group entity alone, but also the parent and the subsidiary. There's a lot going on there. And some of the big issues with these is when the employee works for one entity, but the shares are actually in, let's say, a listed entity, which is the parent entity or the group entity level. The question really comes down to who is the employer? How is the subsidiary in that sort of scenario accounting for these transactions? Are they the employer, or are they just actually administering the scheme on behalf of the parent entity? Is there a recharge between the various entities where the one entity is issuing the equity, but the other entity is receiving the goods and services from the employee? And sometimes you actually have problems where you might have double counting, because the one entity, let's say the subsidiary, might record a share-based payment expense, but might also be getting a recharge from the group entity, and then they've got a double expense in their income statement. The question is that appropriate, and should adjustments be made? So these can actually become quite problematic. And then another one which kind of reared its head recently, which I never really saw coming until the question was put to me by a client. They've actually got group entities in a multinational situation where there's different employees in different countries, and then they also had foreign exchange differences arising on some of the transactions, and especially on the recharges. And then they also ran into a transfer pricing issue where they actually came very close to breaching a transfer pricing policy, because there was something that was transferring between group companies which had not been addressed in their policy, and we had to get our tax guys in there to assist. So you know, there's a minefield here, but like we said earlier, the sentiment is don't not do these things. Just go into them with your eyes open, knowing that everything you do at a group level has a consequence and needs to be addressed. So that's it, Aletta, on those.
Kevin, thank you very much. Always lovely to see you. Although I haven't seen you in person now for nearly 2 years, and I do miss you, it is lovely to see you every month on the webinars at least. And thank you for your contribution as always. So, you know, if you want to know more about all these things, we have our monthly accounting news, and we've got Cheryl Levine in Sydney that runs with this accounting news at the highest possible standard I've ever seen. She's absolutely amazing. And I'm always, every month, amazed at the quality of what she puts together here. She and a team helping her. We've got our monthly client webinars, of course, that you can register for, and you've attended today. On our website, we've got a lot of very useful information. You know, a big thing at the moment is clients are speaking to us about getting ready for general purpose financial statements next year. And then linked to that, we've ignored the leaser standard, but now that we're going to general purpose, we can no longer ignore it. And that seems to be one that's really been ignored in the past. Please speak to us about the 5 steps to get to general purpose by 30 June next year. It's going to be a wild ride. Hold on tight. We've got our virtual workshops. We're nearing the end of a series of 20 virtual workshops, but if you miss them, you can still buy them, $150 each. We've got the recording, all the materials. If you're still getting ready for audit, or if your auditor are asking uncomfortable questions, please give Kevin or I or our team a call and we can try and help you. We would love to help you in an advisory perspective to have those discussions with your auditors. Again, if you're looking to IPO, please speak to us about an IFRS health check. You know, lead. We are currently doing another big implementation of BDO lead at a large entity. We've just finished a not-for-profit one, so that's where they have their own software as a service in the cloud. But if you want to outsource to us, we've got a number of people just doing outsourcing. We have a new person that also started on Monday, Ryan Lopesha, who's been employed to help with lease accounting. It's just growing by the day. So Excel is not cutting it. Please outsource to us, or let's get some proper software. And I want to say, please look at software that don't have workarounds and all kinds of stuff happening outside the system. It becomes a pain over time. Our IFRS leaders, as you know, Ashley is usually here with us. However, she's an audit partner, and August and September are crazy times in audit, especially if you're based in Perth. So Kevin and I have given her said, Ashley, focus on audit clients. We can do the webinar today and in September. Obviously, Kevin Clark, very experienced partner based in Brisbane. And then Lynn, that's looking after all our IFRS advisory work in Adelaide. But any questions anywhere in Australia, please contact us. We can help you. So that is the big team. You can see Ryan is so new, I don't even have a photo for him. And Kevin, I know Lara joined recently and I don't have a photo for her. I don't know if I lost it. And then I know you've just employed another person. So by next month, we'll have another one there as well. So the team is growing. We're moving to general purpose. We're moving to sustainability reporting. But thank you very much for joining us. If you're in Sydney in particular, please take care. Please stay safe. That's for everybody, but in particular our friends in Sydney. You guys take care.
Bye, Aletta, and goodbye, everybody.